This video is an original educational documentary inspired by One Up on Wall Street. It is not a reading or reproduction of the book. Every section contains original explanations, analysis, commentary, and practical examples designed to help viewers understand the underlying investing concepts. This video is for educational purposes only. It is not financial or investment advice, and it does not recommend buying or selling any security. Investing involves risk, including the possible loss of capital. Past performance does not guarantee future results. Imagine walking into a supermarket. You notice that one product is always sold out. Every time you visit the shopping center, one clothing store is crowded while another sits almost empty. Your children cannot stop talking about one particular video game. Your coworkers suddenly begin using the same software. Most people simply notice these things and continue with their day. Peter Lynch believed these everyday observations could become the beginning of investment research, not the end of it. Unlike many investment books that begin with complicated formulas, Lynch starts with a simple idea. The world around you can sometimes provide useful clues about businesses that deserve further study. Notice the key phrase, further study. Observation is only the starting point. Real investing requires research, evidence, and thoughtful analysis. That distinction is one of the reasons this book continues to be discussed decades after it was first published. Chapter 1. Ordinary people notice extraordinary businesses. Peter Lynch managed one of the most successful mutual funds of his time. Yet he repeatedly argued that professional investors do not have a monopoly on good ideas. Consumers often discover changing trends before those trends appear in financial reports. Employees may understand their own industry. Healthcare workers may notice medical innovations. Engineers may recognize emerging technologies. Teachers may observe changes in educational tools. Parents may see products becoming increasingly popular among children. These observations can inspire research questions. However, popularity alone is never enough. Successful investment research requires verifying whether a company's financial performance support the initial observation. Competitive position and long-term prospects must be verified. This distinction remains important today, especially in an era where social media trends can spread much faster than reliable information. Chapter 2. Curiosity is more valuable than prediction. Many new investors ask, what stock will double next year? Peter Lynch approached investing differently. Instead of trying to predict prices, he encouraged curiosity. Questions such as, why are customers choosing this company? How does it make money? Can competitors easily copy it? Is demand likely to remain strong? These questions shift the focus away from guessing market movements and toward understanding businesses. Good investment research often begins with asking better questions rather than searching for quick answers. Chapter 3. Understanding different types of companies. Not every successful business grows in the same way. Lynch described several broad categories of companies because different businesses often require different expectations. Some companies grow steadily over long periods. Others expand rapidly but also face greater uncertainty. Some mature businesses generate consistent profits with relatively slower growth. Others experience cyclical changes influenced by economic conditions. Recognizing these differences can help investors avoid comparing businesses that operate under very different circumstances. Rather than assuming every company should deliver the same type of performance, thoughtful investors consider each business within the context of its industry. Chapter 4. Research before excitement. It is easy to become enthusiastic about a company after hearing positive stories online. However, excitement should never replace research. Lynch encouraged investors to move from observation to investigation. Questions worth exploring include, what products generate most of the company's revenue? How profitable is the business? What are its major risks? Who are its competitors? Does the company carry significant debt? Is management communicating clearly with shareholders? Research does not remove uncertainty, but it can improve the quality of decision-making. Chapter 5. Numbers tell a story. Financial statements are more than accounting documents. They tell the story of how a business operates. Revenue shows whether customers continue buying products. Profitability helps investors understand operational efficiency. Cash flow illustrates whether earnings are supported by actual cash generation. Debt reveals financial obligations. No single number explains everything. Professional analysis combines many pieces of information before reaching conclusions. Chapter 6. Great companies still face risk. Even outstanding businesses experience challenges. Consumer preferences change, technology evolves, competition increases, economic conditions shift, government regulations change. Because of these uncertainties, experienced investors generally avoid assuming that any company is guaranteed to succeed indefinitely. Long-term investing involves continuously reassessing whether the original reasons for owning a company still appear reasonable. Chapter 7. Independent thinking. Financial markets are full of opinions, television commentators, online influencers, investment forums, social media discussions. While these sources may provide useful information, Lynch encouraged investors to develop independent judgment. Evidence should carry more weight than popularity. Thoughtful analysis often requires patience, skepticism, and a willingness to question widely held assumptions. Chapter 8. Long-term perspective. Daily market fluctuations attract significant attention. Yet many successful businesses build value gradually over years rather than days. A long-term perspective encourages investors to focus on business development rather than constant price changes. Patience does not mean ignoring problems. It means distinguishing between temporary market volatility and meaningful changes to a company's long-term prospects. Final summary. One Up on Wall Street encourages readers to become curious observers of the world around them while recognizing that observation alone is never sufficient. The book emphasizes combining everyday insights with careful research, financial analysis, critical thinking, and disciplined decision-making. Its message is not that investing is easy. Rather, it suggests that thoughtful preparation, continuous learning, and independent analysis can improve the quality of investment decisions over time. Whether you are a beginner or an experienced investor, these ideas remain relevant because they focus less on predicting markets and more on understanding businesses. Thank you for watching. If you enjoy original educational documentaries about investing, business analysis, market psychology, and financial history, consider subscribing for future episodes.